Pensions legislation works by allowing what are known as authorised payments, which include pension commencement lump sums, I'll abbreviate that to PCLS, or in other words, the tax-free cash, pension income, transfers and death benefits. There are also payments known as unauthorised payments, which are normally avoided at all costs because they incur significant tax charges. Within that category, there are around a dozen payments that are specifically unauthorised. Some are quite rare, but one that crops up frequently in conversations that I have is lump sum recycling. Lump sum recycling is when you take your tax-free pension commencement lump sum, your PCLS, as known as I said before, as your tax-free cash, and then pay it back into a pension as a new contribution. The purpose, of course, is to claim the tax relief that any pension contribution would get. But this means that you would be getting tax relief on funds that had already benefited from tax relief in the past. Some people call this double dipping. The recycling rules aim to prevent this kind of exploitation of the tax rules. To be clear, the recycling rule does not extend to pension income, just to the tax-free cash element. Income must be taxed under PAYE, so there is much less benefit in paying tax pension income back in as a contribution. The money purchase annual allowance rules also make the recycling of pension income more difficult. And you can find out more about the MPAA in another video. I'll put a link in on the screen right now and in the description below. So, lump sum recycling is not allowed, but how can it be identified? Under legislation, there are 6 conditions that must be met for a pension commencement lump sum to be considered recycled. Let's take a look at these. Firstly, quite obvious really, but you must receive a PCLS. So you must withdraw some tax-free cash from your pension. Secondly, the PCLS you withdraw and any other PCLS in a 12-month period must add up to more than £7,500. Thirdly, the amount that you contribute back into a pension must be more than 30% of the amount of the PCLS that you withdrew. Fourthly, your pension contribution must be significantly above what it has normally historically been. Fifth, your contribution can be paid to any scheme you belong to and you are yourself, a third party or your employer. And finally, the recycling must be planned. In other words, it was a conscious, predefined decision. If all these conditions apply, the value of the unauthorised payment is the value of the PCLS received by yourself. If you were found to have broken the rules, there would be an unauthorised payment tax charge of 40%, which you would be liable for personally. What's more, if you crystallise your entire pension when taking the PCLS, an unauthorised payment surcharge of 15% would also apply. This is because the pension commencement lump sum would account for 25% of the whole pension scheme. The scheme administrators don't get off scot-free. There would also be a scheme sanction charge on the pension itself of between 15 and 40%, depending on how much the unauthorised payment charge that you paid. However, if the scheme administrator was unaware of your plans, it may be able to ask HMRC to discharge its liability. The rules are quite clear, but there are a lot of criteria that need to be met for lump sum recycling to be proven. So how does HMRC approach this problem? While most of the 6 conditions are straightforward to apply, 2 are much harder to assess. Firstly, what constitutes a significant increase in contributions? And secondly, what constitutes prior planning? HMRC covers both of these in its published guidance. So taking the contribution point first, HMRC uses a 30% rule of thumb. This means that the HMRC are unlikely to scrutinise additional contributions unless they are 30% more than what you might have otherwise usually paid in. They will also ignore increases that are outside your control, such as contractual increases and increases that are due to natural fluctuations, and they will consider the broader context. So let's try and give you an example of changes in pension contribution levels. Sandra runs her own business and her income fluctuates, and for many years she's contributed 10% of her income each year to a personal pension. And during COVID-19 pandemic, sadly her income virtually stopped, so she took a pension commencement lump sum from her personal pension to make up her income. so she took the tax-free cash. Sandra changed how her business operated and it bounced back strongly. So this year she's got a much higher income than normal and she's able to make a much higher contribution than normal, but is still at 10% of her income. Now, from a recycling perspective, this latest contribution is likely to be disregarded by HMRC because it was made on the same basis as contributions in previous years, i.e. at 10% of her income, and had no relation to any PCLS payments. When assessing increases in contributions, HMRC works on a cumulative basis and will look at contributions over a 5-year period. This period includes the tax year in which you took your PCLS, the 2 tax years before that, and the 2 tax years thereafter or after that. This is to enable them to identify cases where people are attempting to spread the increased contribution over several years to avoid being detected. Now, looking at the second question of how HMRC assess whether someone has intentionally planned to recycle their lump sum, the guidance does not indicate what evidence can or cannot be taken into account. It does say, however, that the onus is on HMRC to demonstrate that you had planned to increase your contributions following receipt of a pension commencement lump sum. It's also important to know that HMRC's guidance is clear that recycling can involve more than just the 2 transactions of lump sum and contribution. It will look beyond these and take into account other transactions around the time period. What's more, there is no set order of transactions and the actual PCLS funds do not have to be used to make the contribution. So let's give you an example to illustrate what I mean. So if you borrowed money in order to make an increased pension contribution and then received the PCLS and then used some or all of that PCLS to pay off the loan, this would put it in the category of recycling. So how does HMRC identify recycling cases? Because it can appear quite ambiguous. It's certainly challenging for HMRC because there's no requirement on scheme administrators to monitor for recycling or report suspected cases. Recycling is an unauthorised payment, so a scheme administrator would have to report it if it took place. However, the administrator is unlikely to have the full facts, so would rely on you, the member, to tell them what is it you are doing. HMRC will of course have details of tax relief granted on all personal contributions, but they will have far less data on the PCLS payment. Some PCLS payments must be included on a pension scheme administrator's annual report to the HMRC. So for example, if you're relying on a form of lifetime allowance protection, but the majority of PCLS will not be reported at all. You might ask, when is it okay to contribute to continue to make pension contributions having taken a pension commencement lump sum? Well, let's take an example of Steve, who's got a defined benefit pension. He's retired from the company and he's started taking benefits, including a PCLS from the DB scheme. But Steve then carries on working as a consultant, and he's fortunate enough to have a comfortable pension income from the defined benefit scheme, so he can afford to contribute most of his consultancy income into a SIP, with the aim of eventually passing that SIP onto his children. And on paper, HMRC could potentially view this as recycling. But when we know the details of Steve's story, it's clear that the PCLS and following contributions are unconnected. It is clear then that the lump sum recycling is quite difficult to detect, and it's difficult to know how closely HMRC monitors for it. So the rules were probably included more as a deterrent rather than anything else. The guidance certainly suggests that PCLS won't be caught if paid as part of your normal retirement planning. And the fact that the annual allowances decreased significantly in recent years makes it harder to recontribute significant lump sums to your pension anyway, which might push lump sum recycling further off HMRC's radar. Thanks for checking out my YouTube channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help people live successful lives. And that, in my experience, often involves understanding your money. I hope you've enjoyed this video. If you have, please press the like button to help more people find my channel. And for now, I'm Justin King, helping you live your best life.